Hey folks, hope you're all doing well and welcome back to another lesson on this YouTube channel. So in today's lesson, we will talk about the Ict Silver-Bullet model, which you might have heard about. It's one of the more popular ICT models. I think if you had to ask me what the most popular ICT models were, that would be the 2022 model and the Ict Silver-Bullet model. So I understand if you want to learn these models, they are great models and they work very well when the rules are met and followed. And that is usually the hardest part for traders. So this is a time-based model, okay? It's a very, very time-based model, which means this model has to be executed within certain time intervals, okay? The most important part about ICT in general is the time, right? And in this model, it's even more significant because you have a 1 hour trading span, right? You have 1 hour whenever this appears to find your setup. Otherwise, there's no trade. This is essentially split up in 3 sections, or rather in 3 time intervals. So the first tradable hour is between 3 a.m. New York local time and 4 a.m. New York local time. A lot of orders are distributed during the hour between 3 a.m. and 4 a.m. And it usually leaves behind a fair value gap. And that fair value gap is your key to success when trading this model. Okay? You are only going to be executing your trades based off of a fair value gap, no other PDRA. So the second tradable hour is between 10 a.m. and 11 a.m. New York local time. And the third and final tradable hour is between 2 p.m. and 3 p.m. New York local time. Okay? So essentially what you're looking for within these specific time intervals is a run on buy or sell stops, a displacement in the opposite direction of the liquidity run, and a fair value gap before. You always take the first fair value gap within that specific time interval and you target opposing liquidity and put your stop below the low or the high. It's very, very simple, okay? So let's go into the charts and I'll show you some examples for reference. So as you can see right here on the screen, I have marked out the 3 and 4 a.m. time interval. When I trade the Silver Bullet, this is my most successful hour out of the 3. So right here, we are on the NASDAQ 100 on the 15-minute time frame. And the reason for me being on a 15-minute time frame is because I draw my liquidity out on the 15-minute time frame, meaning that I find my liquidity on the 15-minute time frame before we enter that 3 to 4 a.m. time interval. So this would be my sell side, and this would be my buy side liquidity. So what I do then, once I have established my liquidity, I drop to a lower time frame. This has to be executed on either the 30-second, 1 minute, 2 minute, 3 minute, 4 minute, or 5 minute chart. Okay, that is what I recommend. You only have 1 hour, therefore it does not make sense to use the 30-minute chart, right? You're not going to get a fair value gap on the 30-minute chart in an hour. So I would use the 30-second, 1 minute, 2 minute, 3 minute, 4 minute, and 5 minute chart. I usually execute this model on either the 1 minute or the 2 minute chart. So as you can see, this is the 2 minute time frame on NQ. And as you can see, that blue line represents the sell side liquidity that I drew out here on the 15-minute chart. So this is 15-minute sell side liquidity that has been swept. So after I see this, keep in mind that these lines represent 3 a.m. here, 4 a.m. here. So I want everything to happen within this specific time window. So we get our liquidity sweep within the 1 hour time frame. And Now we wait for displacement in the opposite direction that leaves behind a fair value gap. And you take the first fair value gap that it forms. So we have displacement there. We went down a bit lower, but we had displacement to the upside, right? And this is the first fair value gap after the displacement and after the liquidity sweep that formed. And as I just taught you, this is the one you take. You enter as soon as we hit the top of the fair value gap, in this case, because we're bullish, right? And I know for some people, especially if you've traded retail for a while, entering off of completely bearish candles can be very scary at first, but you must learn this. As soon as this candle taps the fair value gap, you place your entry order and your stop goes below these two lows here, and your take profit goes up here, right? That's the buy side liquidity. These are the lows. As I said, you put your stop either at the high or the low, depending on in which direction you're trading. So in this case, we would put our stop below the low. That's this one. Our take profit at the next liquidity pool, which is this one up here, right? So the trade would look something like this, right? It is a very, very, very simple strategy. And I would only do this. The things that I've just taught you are the only things that I would look for with this model in the beginning. Once you master it and have traded it for a long time, you could start tweaking it. You could start adding bits to it if you want to. Some people, they're fine with a liquidity sweep that happens before the 3 a.m. Mark, because then they have their draw, and the likelihood of it sweeping something else within that 1 hour time frame, if you have just swept something significant, is not very likely. So, but these are people that have traded this specific model for a very long time, so therefore they have the screen time and experience to be able to tell when it's going to do certain things, right? So imagine you traded this model for 1 year, focusing on one of these time intervals. Let's say it was the 3 to 4 a.m. time. Imagine how good you would become at figuring out what price is most likely going to do in that 1 hour. People are trying to master 4 or 5 different pairs or stocks or whatever. Imagine you just focus on 1 hour. Imagine you master 1 hour of the day. You could become insanely good at this, right? You would know what setups to take, what setups not to take, what setups has a high probability, what setups doesn't. If it does this before the 3 a.m. mark, then I'm probably not going to place the trade. And if it does this, then I am probably going to place the trade. So experience and screen time is everything, right? That's a lot. But as long as you follow the rules that I just provided to you, this has a very, very high probability of winning, okay? ICT personally called this the quit your job in 90 days model, okay? That's a bit controversial, but you get the point, right? It's a very successful model if followed correctly. And I understand why you wanted to learn it, so I was here to learn it to you. So I hope you understand this model at this point. It is not the most difficult model to understand. And if you have any questions about this specific video, just ask in the comment section. I am always open to answer. And do not feel bad if there's certain things you don't understand. These concepts are very, very, very difficult to get into if you have never heard about it before. So what I would do is watch the video as many times as you want, take notes, write down the rules I provided, and then tomorrow, try it out. Do it on demo before on live. Demo it for a while. Trade your normal strategy, and then demo this one for a while until you see significant enough results that you become confident enough to switch, if that's what you're seeking, right? So I hope you enjoyed, and I will see you in the next video. Bye-bye.